Now, as for economic data, for the second time this week, we will get a read on the U.S. housing market. Sales of existing homes probably climbed last month to the highest in almost a year. Well, at least that's what some economists are saying in our Bloomberg survey. It would be the fourth straight monthly gain, the longest stretch of increases since the housing bubble burst. That report due out at 10 a.m. Eastern Time. James Knightley, an economist at ING Financial Markets in London, predicts a 5 million annual rate in resales. He joins us now live to talk more about the upcoming housing report and the economy overall. Good morning. Thank you so much for joining us. And let's start with the fact that on Tuesday, the market focused on the rise in single-family home starts, yet the overall number, which includes multifamily units, unexpectedly fell. So how does Tuesday's uneven report affect sentiment ahead of today's numbers?
Yeah, I mean, I think, to be honest, it was pretty much in line with general expectations. And if you look at what's happened to pending home sales, which tend to lead these indicators, they're up very strongly indeed since the start of the year. They're up around, say, 18–19% since January, whereas today's existing home sales have only risen by around 9%. So potentially there is quite a big catch-up to come through.
Now, there is that big drop-off that you referred to between pending home sales and existing home sales. When does that start to narrow?
Well, at the moment, I mean, there is a discrepancy, and there are a number of factors behind that, because people may sign up to buy the house, which is where the pending home sales numbers get calculated, but things can happen between then and actual completion, such as people losing their jobs, people not being able to get a mortgage, or people not actually being able to sell their current property in order to move into their new property. So these factors are still weighing on general economic activity and are likely to continue a discrepancy between these reports. But hopefully, as the economy gradually strengthens through the latter part of this year and into next year, that discrepancy will narrow.
Now, the financial markets have been keying off this recovery story since early March. Have the recent gains gotten ahead of themselves?
It depends. I mean, there's still the question mark about the sustainability. I mean, the one industrial production rise in the first 19 months is a positive, but it's not going to continue for long if there isn't the final demand at the end to keep it going. And in this regard, you know, the inventory bounce we're seeing is likely to promote a third quarter positive GDP number. But if the consumer numbers continue to disappoint, like last week's retail sales number and the consumer confidence number, then there are going to be ongoing question marks. But hopefully, with ongoing stimulus as well, that will gradually start to see some modest rises, possibly later this year, but more likely into the early part of next year, where we may get another fiscal package.
Now, you mentioned the consumer. Let's get back to the fiscal package in a moment. You mentioned the consumer, and bigger picture, your forecast of 2010 GDP for the U.S. is 1.6%. That is lower than the consensus. What are you factoring in here that the rest of your peers are not?
Well, again, it is the consumer sector that we are concerned about. Certainly, the industrial numbers have been getting better, the inventory numbers have been getting better, but again, you need the sustainable consumer spending, which makes up 70% of the economy, in order to guarantee this recession, well, the end of the recession. And in terms of headwinds to the consumer, you've got structural factors, such as people borrowing less, saving more. You've also got the ongoing job loss situation, you've got wage growth slowing, you've got gasoline prices rising, and you've got mortgage rates creeping up. And all those are negatives still for the household sector, especially when it's still very, very difficult to get credit in order to go out and spend.
Okay, got you there. Thank you so much, James Knightley over at ING Financial Markets in London.